Hello traders, you're welcome to this video. In this video, we are going to be discussing the buy low and sell high strategy. Buy low, sell high is a common concept in trading. Every trader wants to buy low and sell high, but how do you know when to buy low and when to sell high? Or how do you know when a low has formed for you to buy and when a high has formed for you to sell? You might want to stick around till the end of this video as we look into this strategy. Certainly, the buy low and sell high strategy is a fundamental principle in trading. So, we are going to be looking at the key concepts and why it is essential. Okay, this strategy focuses on purchasing a currency pair. Let's just go to higher time frame for the purpose of this video. So this strategy focuses on purchasing a currency pair when the price is low. For example, buying around here and then selling it when the price is high. For example, selling around here just before a reversal or before a retracement. This approach relies on understanding market trends and price movements, allowing traders to make informed decisions. Now, why is this essential for all traders? For traders of all levels? Because of its simplicity. One, this strategy is straightforward and it is easy to understand. Basically, knowing when a low has formed so that you can buy low, and knowing when a high has formed so that you can sell, right? It's so simple. Now, the flexibility is another important factor because it can be applied across various trading styles. Now, you might have your own unique trading strategy, but this particular strategy can also be applied. It can be inculcated into your strategy, and it can be used across all time frames. Whether you are a day trader or a long-term investor, you can be able to use this strategy. And also, by focusing on buying at lower prices, traders can potentially limit their losses, right? Because when you are buying low, the risk you will be taking will be less compared to someone that is buying at a higher price, right? So it assists in terms of risk management. Now, the key concepts of this strategy are that it helps in identifying market trends, right? Because, for example, when you have subsequent highs, remember we've already talked about the use of trend lines. We have subsequent highs like this. It's obvious, or subsequent lows. It's obvious that this is a bullish trend, right? So now, after the first or second, or after the second or third formation uh, of a low, after the second formation of a low, or the third, after the second, you can even decide to buy right after the price comes to form the third low. Okay, so basically we are going to be needing support and resistance for this strategy. This strategy works because for you to be able to identify highs, identify lows, you will need support and resistance levels. The support and resistance levels are going to tell you when a high has been reached, when a low has been reached, and some cases you can also add indicators such as momentum indicators that we can be using. We can decide to use the stochastic indicator or any other indicator of your choice that can potentially suggest when a high has reached, such as indicators that give overbought and oversold levels. Okay, so now basically when you are using support and resistance levels, you will know that when after price had already rallied up to this point, as it came down, you can see that there was both a dynamic and support and static support around here. This trend line is acting as dynamic, this horizontal line is acting as a static, right? So this was a support level. We will know that a low has formed. Okay, you can also decide to look out for candlestick patterns as well if you can find any. However, even if you don't find any candlestick pattern, you can just base your decision on the support or resistance levels, but make sure you always use stop loss in case of if price do not respect that support or resistance level. So basically this is a low. Once you buy here, you would want to target the next high. So in this situation, you have to look out for a possible reversal signal. So you might not just want to use the next resistance as your take profit. Instead, you might want to look out for a sign of a reversal. Now, there was a sign of a reversal here, as that we can see that an inverse hammer formed around here. We can see this inverse hammer form around here. So we would have considered exiting our buy trade around here, assuming that this was a high. Although the price eventually broke through this resistance and formed an actual high, but just to be on the safer side, you can decide to look for candlestick patterns that can assist in suggesting that a high has probably been reached. And then you can also use your stochastic oscillator or any other momentum indicator to know when an overbought level has been reached, okay, just for extra confirmation. All right, now make sure that you always manage your risk, okay. Position sizing is very important. You have to determine the amount of capital that you want to risk on each trade. So generally, many traders recommend to be no more than 1 to 3% of your trading capital per trade. Yeah, many traders usually prefer to risk maximum of 3% of their capital in one trade. Okay, so depending on your risk tolerance, you decide the percentage of your capital you want to risk per trade. Now, make sure that you always use stop loss orders. It's very important so that you don't end up losing more than what you had anticipated or what you had budgeted, okay? Because no one wants to lose money, but just to be on the safer side, you should use stop losses just to make sure that you do not lose more than what you had budgeted, okay? And then in terms of risk to reward ratio, you might want to have a good risk to reward ratio. Now, you might want to aim for a minimum of 1 to 2 or 1 to 3, meaning if you are risking $1, you should be targeting to make $2. That's for a risk to reward 1 to 2. But for a risk to reward 1 to 3, if you are risking $1, you want to be targeting to make $3. That's for risk to reward 1 to 3. Okay. Now, some practical tips when using the buy low and sell high strategy. Remember that support and resistance levels are very, very important because you can use that to determine when a low has been formed and when a potential high has been formed, irrespective of the time frame that you are working on. All right, the time frame that you are analyzing, the time frame you are trading on. Okay, try as much as possible to set your support and resistance levels so that it can give you ideas of when a potential high and low has been reached. And then the use of other indicators, especially those that give overbought and oversold signals, okay, so that you can possibly have an idea of when a potential high has been formed or is about to form, and when a potential low has been formed or is about to form. Now, before we end this video, we're just going to be looking at some practical tips that's going to help you. The first is keep a trading journal. You might want to document your trades because it helps, including the reasons for entering and exiting, so that you can learn from your experiences. Keeping a trading journal can help you learn from your experiences because in the future, in case of if there was any mistakes you made that resulted into a loss, you can avoid those mistakes in the future, okay? Keeping documentary of your trade, documenting your trades basically can help you avoid future mistakes that you made in the present. Now, stay informed, okay? Follow economic news. Even if you are a technical trader, try as much as possible to follow economic news because fundamental analysis is very important, okay? It is economic events that eventually result into huge price movements. Technical analysis can give you entry and exit points, but most of the times the assets follow um, economic events. Most of the times assets follow the happenings, okay, current happenings. So you just might want to stay informed, okay, follow economic news and events that impact currency values such as interest rate changes or geopolitical developments, etc. Now, technical analysis is also paramount. So you might want to use technical analysis tools, familiarize yourself with chart patterns, candlestick formations. In previous videos, we have discussed a couple of chart patterns and candlestick patterns, so you might want to check them out because all these technical indications are very important. You need to know when to enter a trade. Even if you stay updated on economic news and you get to know that an asset is trending, you need to know when to enter because you wouldn't want to enter high, you wouldn't want to buy high, or you wouldn't want to sell low, right? Because price do not move in a straight line. So there are retracements, there are pullbacks, okay? So technical analysis can give you an idea of when to buy and when to sell. So you might want to learn how to use technical analysis tools, okay, to enhance your analysis. Now, practice patience. Fourthly, practice patience. Wait for the right setups rather than focusing on forcing trades. Right? Do not force trades. Wait for the market to give you an opportunity and you grab the opportunity, right? So do not try to like force trades when your strategy isn't showing up in the market. Quality should be given more priority over quantity. Okay. Now you will want to evaluate your performance. Yes, regularly review your trades to identify your strengths and weaknesses. Okay, very important. So that if you know what you did correctly, you would want to keep on doing that thing. And if you know what you didn't do right, you would want to avoid that in future trades. Okay, adjusting your strategy as needed after identifying your strengths and weaknesses. Now, by understanding and implementing the buy low, sell high strategy, traders can better navigate the forex market and towards consistent profitability. They will work. Yeah, because when you understand how the strategy works, you can be able to like focus on consistent profitability. Make sure you practice, keep on practicing, keep on observing good risk management. Okay, good risk management, sound analysis. When you combine all this together, you can be able to have successful trading outcomes. So I hope you found this video insightful. Kindly like and subscribe for more. Also, don't forget to hit on that notification bell so that you can get updated on more videos for more trading insights. Cheers and happy trading.